The market has actually been very busy since the beginning of the year. In our Outlook 2020 report, we highlighted that resilience was a trait that would be required for the commercial real estate industry in 2020, and this has certainly proved apt in the opening months of the year. We've had to contend with the property-related measures that were announced in the budget towards the end of last year. And in the opening months of this year, we've had quite a bit of noise about the status of some of the open-ended property funds, and we had some unrealistic election manifesto promises in the run-up to last month's general election, and all of this has created further uncertainty. Nevertheless, while the negotiations regarding the makeup of Ireland's next administration and the creation of a programme for government are continuing, activity has continued at pace actually in the commercial property sector during January and February, boosted to some degree by a healthy carryover of transactions from 2019, which will boost Q1 sales and leasing activity in many sectors over the coming months. Yes, several new mandates have been activated since the beginning of the year, and there's good visibility on pipeline over the coming months, which is encouraging to the many investors who continue to seek investment opportunities in the Irish market. Activity in the office and industrial occupier markets remains particularly healthy, with new supply continuing to be delivered, albeit on a very controlled and measured basis. Investment activity has also remained robust, and I suppose with the exception of retail, yields in many sectors of the market have potential to compress further as new transactional evidence ultimately materialises. However, at this juncture, the market does require visibility on the programme for government. This is particularly true in the multifamily sector of the market, where residential investors need clarity on the potential for a rent freeze, a measure that has invariably proved counterproductive in many other markets across Europe and indeed in the US. Activity in the Dublin office occupier market has been brisk during the opening months of the year, boosted by the carryover of transactions from last year, as I've already mentioned. There was more than 120,000 square metres reserved at the end of the final quarter of the year, some of which is due to sign over the coming months. And I suppose despite the air of uncertainty that has prevailed in Ireland since the recent general election, the fundamentals of the Dublin office market remain sound. Demand is at an all-time high, and supply is coming on stream in a very controlled fashion. And indeed, even before any 2020 transactions are recorded, almost half of all the office stock that is currently under construction in the capital has already been pre-committed. There's been a notable increase in small and medium-sized requirements in the last couple of months, which is encouraging. Some of this is emanating from Indigenous companies that are now proceeding with office searches now that Brexit uncertainty is eased. Some is from firms that are looking to come out of flexible space, and some has been triggered by upcoming lease events. No, in addition to strong demand for modern office accommodation in Dublin, there's currently solid occupier demand for new office buildings that are under construction in some of our provincial cities, including Galway, Limerick and Cork, and that will give rise to leasing transactions being announced in these cities over the coming quarters. Take-up in the Dublin industrial and logistics market has reached more than 330,000 square metres last year, up about 9% on the previous year and 21% higher than the 10-year average. This momentum has carried over into 2020, with the months of January and February both considerably busier than normal in this sector of the market. To some extent, this is related to Brexit, with several occupiers now proceeding with expansion and relocation plans now that the direction of Brexit is somewhat clearer than it was last year. In addition to several sales and lettings of industrial buildings throughout the capital over the last couple of months, there's been considerable off-market trading of land during the opening months of the year, led for the most part by demand from data centre and logistics operators. Yes, I suppose spurred on by the strength of occupier demand for new industrial and logistics buildings, several of which were let prior to practical completion during the last 12 months, a few developers have now commenced further speculative development or lodged planning for additional phases of schemes. Prime industrial rents in the capital are relatively stable at about €110 per square metre, but are expected to increase by about another 5% during 2020. Yes, retail is a sector that's been having a difficult time across Europe, but activity in the Irish retail market continues to counter the European experience. The underlying trend of both retail sales activity and consumer sentiment in Ireland remain broadly positive, despite the structural issues facing the retail sector in general. This is supported by strong employment growth and strong wage growth domestically. Prime retail rents in the Irish market are holding up well, with a number of notable transactions imminent on both Grafton Street and Henry Street, which will underpin the current Zone A rental tone on those streets. Occupier demand is still encouraging, albeit emanating from a myriad of different types of retailers, as opposed to the fashion retailers who were particularly dominant in previous years. There's very strong demand from food and beverage, beauty, service, leisure sectors, etc. Some landlords are taking time to assess deals before making decisions in the current climate, and that is slowing up the pace of leasing activity somewhat. Other deals are stuck in legals. Absolutely, with new supply starting to come on stream for the first time in many years, and indeed some retailers looking to downsize their retail portfolio of stores around the country, there are some excellent opportunities for retailers at this point in time, who, whether they're seeking to gain a foothold in the market or to increase their existing presence. We're confident of continued activity in this sector over the coming months, with several new entrants expected. However, despite the fact that the Irish retail market is performing at a different pace to the UK, the generous incentives that are being given to retail tenants in the UK has and probably will continue to have an impact on retailer expectations in markets such as Ireland. Yes, total returns from Irish commercial property reached 5.1% last year, according to the MSCI Irish Index. And this is a respectable, ungeared return that is attractive to long-term investors, particularly when the strength of Irish economic activity and underlying occupational demand is factored in. Activity has continued at pace in the market in recent months, with several transactions completed, many of which were completed by CBRE, assets continuing to be launched for sale, and demand from investors remaining strong. That said, the sooner there's clarity on the complexion of the next government, the better. Investors need clarity on the programme for government and the potential implications for both the Irish economy and the wider commercial property market. Yes, although there's been an increase in new home delivery in the market in the last 3-year period, and particularly last year, the market is still fundamentally undersupplied in terms of all tenures of housing. The underlying imbalance between supply and demand in the Dublin housing market remains very much in evidence in the opening months of the year, and that in turn is encouraging investors who are continuing to source multifamily investment opportunities in an effort to alleviate pressure somewhat by providing much needed rental stock. Investors have, however, been clearly concerned by some of the election manifesto proposals put forward in the run-up to the recent general election, and in particular the proposal to potentially freeze residential rents, a measure that would potentially prove counterproductive in the long run. Despite the uncertainty that has prevailed, there has been good activity in this sector of the market in the last couple of months, with several transactions signed, competitive bids continuing to be received on other assets that are being offered for sale. Prime multifamily yields are currently stable at 3.75%. The trajectory of yields from this point forward, however, will be dictated by whichever direction the programme for government takes in relation to capping or not capping residential rents. As we outlined in our Outlook 2020 report in January, if any form of rent control is introduced, it will dampen demand for multifamily investment, it will impact on returns, and ultimately it will impact on pricing. Having recorded almost 1.2 billion of trades during 2019, the Irish development land market started well in 2020, and it was boosted by a carryover of sales which were agreed towards the end of last year. In addition, there's been considerable activity underway off-market in the opening months of the year, most notably in the industrial land market. Demand for residential sites continues at pace, with particularly strong demand for both zoned and unzoned land in Dublin's commuter belt. Several strategic sites are being prepared for sale at present, and there's a good level of pitching underway, which suggests that there will be a good pipeline over the coming months. There's been a notable increase in appetite for hotel opportunities in provincial cities in recent months. Having said that, international capital is still predominantly focused on the capital city. Although there has been some deterioration in terms of hotel performance measures, such as RevPAR and occupancy over the last couple of months, Dublin continues to outperform other European capitals, with tourist volumes expected to increase substantially over the coming weeks in the run-up to the annual St. Patrick's Day festival. From a property market perspective, market conditions and the strength of appetite for hotels traded last year has focused minds, and it's encouraging some hotel owners to bring their hotels to the market. Following on from the successful sale of several high-profile Dublin city centre hotels last year, including the Conrad in Dublin 2 and the Marker in Dublin Docklands, we expect to see particularly strong demand for hotels such as the Marison in Dublin 1, which we've recently brought to the market, guiding in excess of €80 million. Well, I suppose following several years of underinvestment, it's no surprise that healthcare was one of the main issues exercising Ireland's electorate in the country's recent general election. It now remains to be seen what the new administration will do to alleviate pressure in this sector, where significant investment is urgently needed. Stringent new regulations that are due to come into force at the end of next year will mean that many smaller, non-purpose-built nursing home properties throughout the country may now have no option but to close, as the cost of compliance with new regulations would simply be prohibitive. It'll be interesting to see what this means for the 125 public nursing homes around the country. Could HIQA start ordering the closure of some of these facilities? Or is there capital available from government to bring these facilities up to the required standards by the deadline of end 2021? Even if some of these facilities are closed, it will put further pressure on the private sector at a time when current fair deal rates are making new nursing home development unviable in most locations. We've continued to see strong investor appetite for healthcare properties since the beginning of the year, with spend only hampered by a shortage of supply. We expect to see further consolidation in 2020. There are several European groups keen to acquire owner-operated facilities throughout Ireland. The Cork property market has actually had a relatively quiet start to the year, both from an occupier and investor viewpoint, although there has been some off-market trading of land in Cork in recent months. There's been quite a bit of activity in the office leasing market in Cork since Christmas, but this will take some time to solidify into completed transactions. Meanwhile, development is continuing at pace on several new office schemes in Cork. According to our research, there's about 5 schemes under construction in the city at present, which between them will deliver more than 64,000 square metres of new supply, with more than a quarter of this new stock already pre-let before any 2020 transactions are counted. As outlined in our 2020 report, some new investors deployed into Cork during 2019 for the first time, most notably Barter Capital, Ugrove REIT, LRC Europe, Henderson Park and IRAS REIT, and we're likely to see others of that ilk investing in 2020 if sufficient investable opportunities come available in the city. Indeed, there are several inquiries at present for lot sizes of between 20 million and 40 million euro in Cork at present. Whatever the hue of the next administration, we would encourage engagement with the commercial property industry. We need long-term thinking to bring certainty to this sector, which has a vital role to play in the economy.